Hey everyone, and welcome back to Passive to Powerful channel. I'm here in the heart of New York's financial district, right behind the iconic charging bull of Wall Street. This bull is a symbol of aggressive financial optimism and prosperity. It's about patience, consistency, and a concept so powerful that Albert Einstein supposedly called it the eighth wonder of the world. I'm talking about compound interest. So, what exactly is compound interest? Let's break it down. Simply put, it's interest on interest. When you invest money, you earn a return or interest. With simple interest, you only earn that return on your initial investment, your principal. But with compound interest, you earn a return on your initial principal and on the accumulated interest from previous periods. It's like a snowball rolling downhill. It starts small, but as it picks up more snow, it grows bigger and bigger, faster and faster. Let's imagine you invest $1,000. If you earn a simple 10% interest each year, you'd get $100 every year. After 20 years, you'd have your original $1,000 plus $2,000 in interest, for a total of $3,000. Not bad. But now, let's see what happens with compounding. In the first year, you earn $100, just like before. But in the second year, you earn 10% on your new total of $1,100. That's $110. The next year, you earn 10% on $1,210, which is $121. See how it's starting to accelerate. That's more than double the amount you'd have with simple interest. The difference is the magic of compounding. Now, you might be thinking, that's cool, but how does this apply to my own portfolio? This is where it gets really exciting. There are three key ingredients to maximizing the power of compound interest in your investments: the amount you invest, the rate of return, and, most importantly, time. First, let's talk about the amount. The more you can invest, the bigger your starting snowball. This is your principal. It could be a lump sum, or it could be small, regular contributions to an investment account, like a 401(k) or an IRA. The key is consistency. Even small, regular investments can grow into a substantial sum over time, thanks to compounding. Think of it like planting seeds. The more seeds you plant, the bigger your potential harvest. Second, the rate of return. This is why people invest in assets like stocks and index funds, which historically have provided higher returns than a standard savings account. Of course, higher potential returns often come with higher risk, so it's crucial to have a diversified portfolio that matches your risk tolerance. But the goal is to get your money working for you and earning a return that outpaces inflation. The third and most crucial ingredient is time. Time is the secret sauce of compound interest. The longer your money is invested, the more time it has to compound and grow exponentially. This is why financial advisors always stress the importance of starting early. Let's look at an example. Imagine two friends, Alex and Ben. Alex starts investing $2,000 a year at age 25. He does this for just 10 years and then stops, having invested a total of $20,000. He just lets that money sit and grow. Ben, on the other hand, waits until he's 35 to start. He invests the same $2,000 a year, but he does it every single year until he's 65. Investing for a total of 30 years and $60,000. Who do you think ends up with more money, assuming a 7% annual return? You might be surprised. By age 65, Alex, who only invested for 10 years, would have a portfolio worth over $300,000. Men who invested 3 times as much money over a longer period would have around $200,000. How is this possible? Because Alex's money had an extra 10 years to compound. Those early years are incredibly powerful because they have the longest time to grow. The lesson here is clear. The best time to start investing was yesterday. The second best time is right now. So, what are the tangible advantages of having compounding work for you in your portfolio? First and foremost, it's the engine of wealth creation. It's how ordinary people can build significant wealth over their lifetimes without having to be stock market geniuses or high-income earners. It's a disciplined, patient approach to financial freedom. Another huge advantage is automation. Most modern investment platforms and retirement accounts make it incredibly easy to set up automatic contributions. You can set it and forget it. A small amount from each paycheck can be automatically invested, ensuring you're consistently feeding your compounding machine without having to think about it. This removes the emotion from investing and helps you stay the course even when markets are volatile. Furthermore, compounding encourages a long-term mindset. When you understand how it works, you're less likely to panic sell during a market downturn. You see dips not as disasters, but as opportunities to buy more assets at a lower price, which can then compound and grow when the market recovers. It shifts your perspective from short-term trading to long-term wealth building. Let's also talk about dividend reinvestment plans, or DRIPs. This is compound interest in its purest form within a stock portfolio. When you own shares in a company that pays dividends, you can choose to have those dividends automatically reinvested to buy more shares of that same company. So now you own more shares, which means your next dividend payment will be larger, which then buys even more shares, and so on. It's a beautiful, self-perpetuating cycle of growth within your portfolio. Now, I want to be clear. This isn't a get-rich-quick scheme. The power of compounding unfolds over decades, not days. It requires discipline and patience. There will be ups and downs in the market. But over the long term, for those who stay invested and let their money work for them, the results can be truly life-changing. It's the difference between retiring comfortably and having to work for the rest of your life. It's the difference between having financial stress and having financial freedom. So, as we stand here by this powerful symbol of finance, remember that the real power doesn't always come from the loudest roar or the most aggressive charge. Sometimes the most powerful force is the quiet, relentless, and unstoppable growth of compound interest. Start today, be consistent, be patient, and let the eighth wonder of the world build your financial future. Thank you so much for watching Passive to Powerful channel. If you found this video helpful, please give it a thumbs up and consider subscribing for more content on personal finance and investing. Let me know in the comments below when you started your investment journey or if you have any questions. I'll see you in the next video.